Unusually, I decided to put my co-authors' pictures on. Sean Higgins, who you heard, Ana Maria Montoya from Universidad de Chile, Eric Parado, who you've heard, and Raimundo Unduraga, also from Universidad de Chile. And the reason I did this is two of the four co-authors are in the audience, and now you can find them if you don't like the paper and have complaints. If you like the paper, then I'm the guy to come to. Okay. All right, so most of the work we're talking about today and tomorrow focuses on consumers and access to financial services and how it benefits them. But a major part of financial inclusion, and in fact, economic growth and employment, has to do with small and medium enterprises and access to financial services for those firms are critical for growth and poverty relief. In fact, SMEs really account for much of employment in low and middle income countries. In Africa, about 80%. Small and medium enterprises typically finance, and especially small enterprises, finance employment or the wage bill from cash flow, current revenues. Many of them are liquidity constrained. And what we mean by that, they don't have reserves, and it's difficult for them to borrow when they have cash flow shocks. So all of a sudden my revenues go down, banks don't want to talk to me because they think I'm a bad risk. So large shocks to cash flow likely force layoffs, unemployment, if these firms can't get access to credit. And layoffs from small businesses have large transaction costs because it's hard for these businesses to find these employees and train them. In fact, one of the big worries of every firm is, if I have to temporarily reduce my labor force, how do I find replacements when revenues come back? That's very costly to firms and very costly to the economy. COVID in particular was a very large shock to the cash flow of most small and medium enterprises. And to deal with those issues, most governments were concerned about the employment effects of these small businesses having to lay off people. And so 145 countries implemented a government guaranteed loan program to small businesses to support employment during COVID. And in the US, we had the famous Paycheck Protection Program that we don't know whether it worked or not. There's some observational work on suggesting it might have improved employment. There's also a large amount of work showing that there was a substantial amount of fraud in that program as well. So this is a very, very popular program. And so fundamentally in this paper, what we want to ask, how useful are these government guaranteed loans in protecting employment in small businesses? Okay. So we got this story, and here's the story. One is there is COVID hits, and the government imposes lockdown to control the pandemic. And so during lockdown and just people worried about contracted COVID, they're just not going to go shopping. In fact, I learned how to shop online and haven't gone back since then. And the biggest problem is my son learned how to shop online and hasn't gone back. And so the lockdowns in particular reduced demands for goods and services. And so there was a large cash flow shock to firms. Okay, and so we're going to use this lockdown period as evidence of when small firms are experiencing a large cash flow. And then if there's a big reduction in the demand for services or revenues, well, banks think these firms are not good risks. So if they're not good risks because they've experienced the shock, I'm not going to lend them money. And so the uncertainty from the pandemic creates risk, and this leads to banks restricting lending to firms. And so firms are in a liquidity crunch. And that liquidity crunch, it means that firms can't meet their payrolls, and so they have to furlough or fire employees. Okay, so then the government comes along. Well, not too fast, I guess. Okay, the government comes along and it says along that golden line, since we're at Cal, my colors are blue and gold. And the government comes along and says, well, you know, I know there's a lot of risk and uncertainty. So what I'm going to do is partially, at least, guarantee these loans. So I want you to loan to risky firms. And in the case we're going to look at, they're going to say, I'm going to guarantee 80% of it. So if that risky firm defaults, you really are okay. And in fact, what I'm going to do is I'm going to infuse your financial institution, your bank, with a lot of capital that you can use to lend out. Okay, and you only are at risk of 20% of that. So the bank's no longer liquidity constrained, and we've really lowered the risk of lending. Okay, so in this case, banks lend to firms. Firms have liquidity they can use, and this allows them to meet their payrolls, and so they don't fire or furlough people. This is the really simple story behind these programs in 145 countries during COVID. All right, so data, how are we going to look at this? We have data on mobility from cell phones. So there's a sample of cell phones. Tell us, based on the cell towers, are people moving away from home for an extended period or not? Second, we have individual small business transactions from 5 banks over a 2-year period. So this is not monthly or daily. This is the individual transactions that we're going to roll up, deposits, withdrawals, loans, loan payments, things like that. We got them from 5 countries: Chile, Colombia, Mexico, Paraguay, and Peru. And Chile is where we're going to be looking. And we got very large samples. So 100,000 firms in Chile, close to 400 in Colombia, 350,000 in Mexico, Peru, 140,000, and about 800 in Paraguay. But Paraguay is kind of a little place with good food, so it's okay. Now, we're going to be doing work using a randomized experiment with a bank in Chile. And how did we get access to a bank and all this private information? Well, it pays to have as one of your co-authors the former bank regulator of Chile and chief economist of the Inter-American Development Bank to negotiate all the data sharing agreements and underwrite all of these risky academics who might give away bank secrets. So we have the formidable chief economist keeping in line so we don't misbehave. Okay, so we got phenomenal data on all of these transactions from 5 countries. And then just to show you what's happening in all of Latin America, that this is not a Chile phenomenon, here we've got the Veriset mobility data. So these are essentially shares of people who go out. We normalize this to February 2020, kind of pre-COVID. And then in each of these countries, what you see is mobility goes way down. Lockdown occurs around this bar in almost all countries. Mobility goes way down and starts to come back up and doesn't really achieve pre-COVID amounts until about 6 or 8 months later. All right. But even though this appears to be, and then you see a similar thing when you look at deposits. So these are each small business's deposits, and it's normalized again to February 2020. And what you see is revenues go way down for a period of time, and don't really come back to pre-COVID periods until about October 20. Okay, so it looks like COVID has about a 6-month shock on revenues. But that 6-month shock, if you don't have enough cash flow, means you can't pay your workers. And so there could be large employment effects from COVID. And what we're going to do is we're going to take this period where there are a lot of lockdowns and ask, what happened to your revenues? Do we see big reductions in revenues? And then we're going to see whether in a randomized experiment, those loans actually helped alleviate that employment level. Okay, so I just wanted to put this slide in here, which is this is the effect on revenues differences by firm size. And there are two competing things going on. One is smaller businesses had less access to credit, less access to liquidity. So that means they had negative effects. But most of the government policies, like the Paycheck Protection Program, were targeted to these small firms. And still in Chile, which is this middle one here, we had much larger effects for small firms. So all right, so I'm going to guess here, I'm blue-green colorblind, like 10% of men. This line is medium enterprise, this is small, and this is micro. And you can see the smaller firms are affected much larger in Chile from COVID than the larger firms. So we have right to be concerned. All right, so let's look at the impact of the Chilean government SME loan guarantee program, which is called FOGAPE. So I'll let you figure out how the acronym is put together on employment. This is a program that the government had going for quite a bit of time. So it wasn't a new program, it was a program that existed. But during COVID, they shoved $14 billion of new liquidity into the banking system, whereas in past years, they had only been putting about $1 billion a year. So there's a massive infusion of liquidity into banks. So think Ben Bernanke here, right? The master of quantitative easing. And they provided funds to banks. 80% of loans to small enterprise were guaranteed by the government, interest rates capped at 7.7%. And then when we looked at the data in Chile, we surveyed 35 banks regionally to see what they were doing with these types of funds. And it turns out all of them said, well, we didn't change our criteria for which firm we were willing to give loans to. So they only gave loans to firms they would have been willing to give loans to without the money, without the government program. And that means that most firms that benefited from these programs were firms that didn't need it, could have gone into the private market. And so that turns out to be a problem. So we, thanks to the strong arm of the bank regulator, got a relationship with BCI. And there we got them to agree to offer these loans to high-risk businesses that most likely they wouldn't, the bank said they wouldn't otherwise loan to, and so they went to higher risk firms. These are firms that had previously applied to a loan but had been rejected. We had about 10,000 of them. These had between 1 and 110 employees, with the median being 3 employees. And we randomized half into being offered a loan and half not. And then the loans were dispersed between February 2021 and June 2022. Those are when the offers were made. About 27% of those offered loans actually took the loan. Okay, and the average loan amount was 13 million Chilean pesos. That's more than a cup of coffee. Okay. All right, so what do we find? Well, the first thing is we want to look at the impact on deposits. So That's not right. I think I'm going to go here. So this is the impact on credit, right? So one of the concerns was, well, maybe all we're doing is giving loans to firms that can easily get loans. So they're taking these cheaper loans and replacing them for more expensive loans they might have been able to get on themselves. So what we see is that no, for a firm that took the loan, they get close to 50% increase in the amount of loan money they can get. So this says that access to this money is money they otherwise wouldn't have got access to without this program. And what's the effect on employment? Well, I know what this is. Let me go back to this. All right. So this asks, what was the impact? What was the impact of lockdown, right? Remember early on I said lockdown preventing you from going out of the house. We hypothesized that reduced revenues that go into the firm. Well, that lowered deposits significantly and substantially. In fact, the deposits go down by about the amount of revenues that they would use for one employee. Okay, so if you have 3 employees and your revenues go down and you no longer have an amount of money to, you lose the amount of money you'd use for one employee, that could lead to layoffs. All right. So yeah, I'm glad I figured out what we did. And then here, what we do is we ask, what's the impact of credit? Well, on employment, what we see is if you're in lockdown, it's close to having 2 more employees in the treatment group getting access to credit if you took up a loan. And if you're not in lockdown, it's positive, but not statistically significant. So we know during lockdown, you're having big reductions in revenues, and that's the period where the firm is mostly at risk. Okay. And that's basically what this says. All right, so what magic have we done today? Well, we've talked about small firms have to finance their employment or their wage bill out of cash flow, and those small firms have limited access to credit. Many firms are unable to maintain their employment during periods of economic crisis when they experience revenue shortfalls because they're living hand to mouth. Firing and hiring employees is costly because they have to find them and train new employees. COVID was a large shock to revenue, especially lockdown. And what we find is the government guaranteed credit for small firms in Chile helped these firms maintain employment during lockdown, which is when they experienced the revenue shock. And this was part of government's COVID response. And this program in particular was targeted to high-risk firms that otherwise would not have had access to credit. And so here, during economic crises, taking high-risk firms and getting them access to credit seems to be an effective way of maintaining employment. Thank you.